Options trading. You can turn a small stake into a serious return or lose it all in a week. So what actually is it and how does it work? When you buy shares, you're committed. Your money's in and you're along for the ride wherever the price goes. Options works differently. Instead of buying shares outright, you pay a smaller fee called a premium for the right to buy or sell at a specific price before a specific date. You're not committing to the trade. You're paying for the choice to make that trade later, if it makes sense to. Think of it like this. A band announces a tour. Tickets are £100, but you're not certain you can attend. Someone offers you a deal. Pay £10 now to lock in the right to buy a ticket at £100, even if they sell out and resale prices hit £300. If your plans change, you lose the £10. If they don't, you've secured the lower price. This concept isn't new. The first recorded options trade was in ancient Greece over 2,000 years ago. The principle remains the same. There are two types and they work in opposite directions. First, call options. A call option gives you the right to buy at a set price. You'd buy a call if you think the price is going up. You're locking in a purchase price now, betting the market price will rise above it. If you're right and the price rises, you can buy at the lower price you locked in, or sell the option itself for a profit. If you're wrong, you walk away, you lose the premium and nothing more. Now, the opposite. Put options. These give you the right to sell at a set price. You'd buy a put if you think the price is going down, or if you want to protect shares you already own. It's essentially insurance. If the market drops, you can still sell at the price you locked in. So, to summarize, calls if you're bullish, puts if you're bearish or hedging. Now, if this video is helpful so far, don't forget to like and subscribe for more investing content in the future. So that's the theory. But how do options actually make money in practice? Let's put numbers to it. Tesla is trading at £200. You think it's going higher, so you buy a call option with a £210 strike price. The premium costs you £8. You've now paid £8 for the right to buy Tesla at $210, regardless of where the actual price goes. Tesla rises to $250, you exercise your option, buy at $210, and you're holding shares worth $250. That's £40 profit per share minus the £8 premium, £32 net. Now, the other side, Tesla drops to $190. Your right to buy at $210 is worthless. Why would you pay $210 when shares are available at $190? The option expires, you lose your £8. That's the trade-off. Amplify gains, but your premium is at risk from day one. Which brings us to the big question. Can you lose money trading options? Yes. And it's worth understanding how. When you're buying options, your maximum loss is capped at the premium you paid. You cannot lose more than your initial outlay, but you can lose all of it. And here's the catch. Options have expiration dates, and every day that passes, your option loses value, even if the share price doesn't move. This is called time decay. You can be right about the direction and still lose money if you're too slow. Options are a powerful tool, but they are not suitable for everyone. However, if you do want to trade options, where do you actually do it? You'll need a platform that supports options trading, and not all UK brokers do. We've broken down our top 3 options trading platforms available in the UK in 2026. That video's on screen now, or you can check out the link in the description for full comparison with fees, features, and what each one's best for. If there's another investing concept you want us to break down like this, let us know down in the comments, and we'll see you in the next one.